Welcome back. Today we're going to talk about market structure. So we're going to start off with an uptrend, what uptrend is, key concept that you have to look for. So right here we have an uptrend which is trending towards the upside, right? So we have higher low and high high, which gave us a higher low, which then gave us a high high. So this previous high high gave us this high high, which got broken by this higher high, resulting in a break of structure. So explaining it a bit more is that in an uptrend, what happens is that when price of something like a stock, like currencies, keeps going up over time, think of it as a staircase that only goes up. Each step is higher than the last step. High high, it's higher than the previous higher high. This higher low give us a higher high, then it gave us a higher low, which is higher than the previous higher low. So this higher low is lower than this higher low. So this higher low give us a higher high, which is higher than the previous higher high, resulting in a break of structure. So if you pay attention quite clearly, is that in higher low, each time when prices drops, it is still higher than the last drop. Okay, this higher low which gave us a higher high, which is higher than the previous higher high, which result in a break of structure. A break of structure meaning that the previous high got broken off by the current high, resulting in higher high, resulting in a break of structure, which this higher low is higher than the previous higher low. Now, this higher low gave us a higher high, which is higher than the previous higher high, which resulting in a break of structure. So this is the way on how you identify an uptrend inside the market. There are many ways you can identify it, but this is the one of the smartest way to identify an uptrend, a trending market. There are a couple of few ways in which you can identify the market. You can identify the market by using a trend line. A trend line is when you place a a trend line below higher lows, right? And the higher it gets, the it gives you more define of what's happening to the market is that it's in an uptrend. So right here we have a uptrend. So we're gonna be moving to the market to show you an example. So inside the market we have trends within trends. So trends within trends occurs in the lower time frame. For example, if you're analyzing on the higher time frame, let me say the 4 hour, the 2 hour, the hourly time frame, or even the minute time frame, there is a structure, the overall direction structure, which is the uptrend. But inside of that uptrend, we have a trend within trend, in which there is small trends within that overall trend, an uptrend inside an overall trend, right? So identifying this will help you to know where the direction of the market is and to know that 80% of the time you should be looking for buying signals instead of selling signals and not go against the trade. As you can see here, let me just click this. We have a higher low in the lower time frame. We have a higher low right here that is higher than the previous higher low, resulting in a break of structure in the lower time frame. So I'm going to show you in the real market, in the structure, and how you can actually identify this. So the structures within structures. So you have to understand what is top-down analysis, in which is going to help you to understand the overall direction of the market. So understanding top-down analysis, it simply by means that you have to go to the higher time frame, which is can be the hourly, daily, minute, but not less than that, right? So it depends on your trading style, whether you're a scalper, swing trader, a long-term trader, or even a day trader. So there are type of time frames you have to look into it. So inside of the overall trend, we have a small trends that are bullish inside the overall trend. Then we have the small trends that are also bearish inside of overall trend. Another bullish trend in which is pushing towards the upside. So inside this trend, we have trends within trends in which are little moves that happen in the lower time frame. As you can see, you have a higher high that is higher than the previous high, then give us a high low, which is lower than the previous low. Then it gave us a high high and a high low, which gave us a push face towards the upside. So let me just zoom in here and show you what's trend within trends and how you can benefit from this trends within trends. So in trends within trend, it's where you find opportunities in smaller time frames. It's where you place your trades, and 80% of the time, always be looking out for buying the market. The reason I say that is that you shouldn't go against the trend. Like water's moving south, water's moving north. Why would you want water to be moving in the opposite direction? Doesn't make sense, right? So going back, we have trends within trends. High, 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 low, high, 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 low, high, 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 low, high, 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 low, high, high, and it continues again and again and again. So within these trends, there are trends within trends. But the key concept of understanding market structure is that even though in the bigger move, when the market is trending towards the downside, you will know it's trending towards the downside in the upper trend, in the upper time frame. But in the lower time frame, it is just making a reversal. So as you can see here, we have initially a downtrend from higher high to higher low. Then from starting from higher low, then we started to see a change of direction. The market starting to change direction by breaking the previous the previous lower highs, right? So breaking the previous lower highs on the smaller time frame resulted in a change of overall direction in the upper time frame. Moving in, we're moving towards the downtrend, which is the second part of it. Then downtrend is an opposite of an uptrend. It happens when price of something like currency, like a stock, keeps going down over time. Think of it as a staircase that only goes down. So each step it is lower than the last step. So in downtrend we have lower lows and lower highs. So in lower lows, in downtrend, so each time price reaches a new low, it's lower than the previous low. In lower highs is that in downtrend, each time prices rises higher, it's still lower than the last rise. So that is the key concept of what is a downtrend. So what causes downtrend to happen is that it's less demand is because less people want to buy the stock, which makes the price to go down. So let's look into the chart. We have a lower low here. Let me just do this. So what causes the market is because of negative news, which a company of some sort or a currency pair that makes people want to sell the stock. So look into the chart. We have a lower low, which gave us a lower high, then a lower low, lower high, lower low, lower high, lower low inside a downtrend. That's what defined downtrend is. Now this lower low gave us a lower high, then gave us a lower low, which is lower than the previous lower low, resulting in a break of structure towards the downside, showing us if we are in a downtrend. So this lower low, which gave us a lower high, it is lower than the previous lower high. Pushing down, giving us a lower low, is the same thing over and over, but it's the opposite. Market structure breaking and pushing the market towards the downside. It is simple concept that you can identify very easily. So look for patterns where each low it is lower than the last low, and each high it is lower than the last high. The key concept here is that it is very easy to understand these key concepts of market structure. What is an uptrend? What is a downtrend? What is a sideways trend, in which you're going to get into in a minute? And what are the key benefit factors that you should avoid in a consolidating trend? So going back to downtrend, I talk too much. Sorry for that. You have a lower low, a lower high, a lower low, which is lower than the previous lower high, which causes a break of structure. So trading this, you can see I'm not talking about support and resistance. I haven't even talking about that. I'm talking about a break of structure and the market structure itself. What causes the market structure? What's happening in the higher time frame, and what's happening in the lower time frame. So you have to understand that we have trends within trends. The overall directional trend in the bigger time frame, whether you're a scalper, whether you're a swing trader, whether you're a day trader, whatever trader you are, you can still identify the very same thing in downtrend, uptrend, whatsoever trend. So right here we have small trends that occur within this overall trend, which is a downtrend pushing lower. And as I explained before, is that in every directional market, is that you always have to look for where the directional market is flowing all the time. If it is flowing down, 80% of the time, you look to sell the market. So let's move into the bigger time frame, into the hourly time frame, to the chart. So market is moving down, up, down, up, which is lower low, lower high, breaking lower low, give us a higher high, which is lower than the previous higher high. So within this, we still have trends within trends that you can use them to trade off of them. So in this key concept, we have a higher high, a lower high, which gave us a lower low, which gave us a lower high, which is lower than the previous lower high. It's that simple. Market structure, easy to identify, easy to be executed, which give us a lower high, which give us a lower low inside the downtrend. So in simple terms, a downtrend is when price keeps going down like a staircase. Each step it is lower than the last, and even when it rises a little, it doesn't rise up high as before. It shows that people are losing interest in willing to sell for less over time. So instead of downtrend in the overall direction, which is a downtrend, we have an overall intra-trend in which we have little move that occur within the lower trend. So looking into it, we have small trend that occur inside the overall direction, which is downtrend. So you can see here we have a lower low, a lower high, a lower low, and a lower high, and also a lower low, a lower high, a lower low, and then lower high inside the overall direction of the bearish direction, no market. So this lower low give us a lower high, which then give us a lower low, which didn't break the previous lower low, but eventually broke it and gave us our low. Now to check here, we have a change in direction in which this current high, it broke the previous lower high, right? Giving us a small bullish trend inside the overall bearish trend. Okay, so it happens most of the time because the market moves up and down, supply and demand. So it always going to occur. But we all know that in the overall direction, we are in a downtrend. That is the key concept. It's understanding where the direction in the higher time frame is going. So understanding this, it makes it easy for us to stay in track and always looking for sell opportunities. Now, part three, we're going to be looking on ranging trends. So in ranging trends, also known as consolidation, we have a trend that is trending between a support and also a resistance. So this trend or this market is bouncing off two walls, which is support and resistance. So what makes a ranging market is that each low is not breaking the previous low. It stays in a range always until it breaks it off. So a ranging market occurs or happens when price of something like a stock like currencies stays within a certain range and doesn't go up and down much. It's like a price is bouncing back and forth between two levels, kind of like a ping pong, right? So inside of these trends, we still have trends within trends. So you can trade them, you can profit from them, but I recommend that you stay away from ranging market. They are very beneficial, but there is a strategy in whereby you can trade them and benefit from them, in which we call them liquidity sweep and whatsoever. You can benefit from them, but 90% of the time, I always stay out of a consolidation trend because I don't want to get bowled out to the market. So how can you spot the market? Is you have to look for patterns where price bounces between the same high and the low points over time, right? So it's a balance between buyers and sellers. There's an equal amount of people who wants to buy and sell so that price stays in a certain range. That is why a range market occurs. And that is why you need to subscribe.